As I was saying, we have had quite a nice rebound on the market since the beginning of the week. So things are looking a little bit better, but lots of those risks still remain in this market, don't they?
Indeed, Stephen, but in your little summary that you had there on the markets just now, you cited quite a few factors which have been improving in the short term. So slowly but surely it does feel like the market's got a better undertone to it. Yes, the risk factors are there, but you know what, as time goes by, the market's getting more and more used to them as we go along and digesting it better and better. It does have a lot better feel to it.
Do you think we've seen enough data, though, to give us a firm indication that we are on a recovery trend here?
No, not at all. It'll take quite a while for us to get enough data to quite firmly say that we are now on the next track of growth. However, we try and look through things longer term, and if we look through it, then it does feel like maybe this is some of the last throes of the bad news that might come into the markets that'll still shake things around, uncertainties like geopolitical things which you can never predict. But it does feel to us that if you look at it longer term, that things are starting to look better.
Well, in that case, how would you be positioning yourself as an investor in this market?
You know, of late, we've had a lot of this risk-on, risk-off type of trading happening, and hence quite a bit of volatility in the markets as players change their minds pretty rapidly. What we are looking at is now to start allocating longer term, to allocate more towards the risky assets, slowly but surely rotating back into where there's better opportunities now than before. We like the developed equity markets right now. Yes, that is the epicenter of where all the risk comes from. But just in terms of the pricing, it does seem like there's very good pricing on the developed equity markets right now. Emerging equity markets, yes, that will be the center of where growth will be coming from. But unfortunately, they are priced to perfection, and they do seem a little bit expensive maybe. So developed market equities over emerging market equities. Then just domestically, recently we've had a bit of a sell-off on the fixed income side. So it seems like if there's still a lot of cash in the system, some of that might find its way back into the bond market. So slowly but surely some good opportunities for more risky assets coming back onto the radar.
And of course, South Africa sitting with those emerging markets. Are our valuations looking a bit expensive compared to some of the developed markets?
Unfortunately, yes, our valuations are kind of expensive. Inside that emerging basket, as I've said just now, is that we do seem expensive relative to the developed markets. The South African market has had a fantastic run, and we've had a lot of good fundamentals going for us. Policy has been fantastic in South Africa. Our monetary policy is very loose, and interest rates are low, and it seems like they're going to stay low for a while. So the fundamentals for our market has been very good, and unfortunately it has been priced quite expensive, but that doesn't mean that it's negative. But as I said, from our perspective, we prefer the developed markets actually right now over South Africa.
How about trying to get the best of both worlds here, George? So looking at those developed market stocks that have exposure to fast-growing emerging markets, so some of your consumer-facing stocks perhaps that are operating here in Africa.
These days, the distinction between what is a developed market stock and an emerging market stock is becoming tougher and tougher. The fact that a company is listed on a developed market or on the US market or on a European market doesn't necessarily make that a developed market company. Many of these companies are becoming global now, and their earnings come from all over the globe, and they are much more diversified. And these days you start seeing people looking through into where the earnings actually come from to classify those. So it's a bit more difficult to make that distinction, but overall the pricing of stocks listed in developed markets seem better value. Indeed, you're 100% right that the growth does look like it's going to come from the emerging markets. So those are the type of companies that one is looking for, yeah.
Would you be looking at specific sectors, George?
You know, domestically in South Africa, what we've seen is that the resources have underperformed the industrials quite a bit this year. So just purely from a value perspective, it does seem like there's more value on that side. If it is so that we're looking through that growth globally does pick up, then the resources sector does seem like the area to be allocating to.
And of course, we had the ECB yesterday extending its quantitative easing, so it's not going to be withdrawing liquidity anytime soon, it looks like. We also have more quantitative easing in the United States. With quantitative easing on both sides of the Atlantic, how does that play into the markets?
Yeah, QE these days, it's the bet is on for where the QEs will stop. We're at QE2 now, and if you listen to Mr. Rubini when he was in South Africa earlier on last month, he called QE 3, 4 and 5, so it seems like quite a bit of quantitative easing still to come. Whilst we don't have inflation in the developed markets, there's no reason why interest rates can't stay low. There's no reason why they can't stimulate those markets even further. So lower interest rates for longer does seem like what we're going to see. Your question on what will we see from quantitative easing, they will keep on pushing at it until the economies start growing or until inflation becomes a problem. But they're going to want to see growth coming first. So inflation is not going to worry them too much at this point in time.
And the impact of this on the fixed income market?
Fixed income markets, tough now because there's a sea of cash around. Unfortunately, since the Fed has started buying US treasuries, the US treasury rates have just risen. So it's a classic situation of buy on the rumor and sell on the fact. However, the fundamentals have improved somewhat for growth recently, so let's not be too harsh on the Fed. Fixed income market overall, you typically expect if quantitative easing keeps on for long periods of time, dollar will start weakening again. As the dollar weakens, unfortunately, we're going to see the rest of the world and especially us emerging currencies improving still. So it does seem like the fixed income environment could be in for stronger yields for longer.
If you had some new money at this point, where would you be putting it? Purely into developed market equities, or are there other opportunities out there?
The opportunity we touched on earlier, companies listed in developed markets, so they valued appropriately according to their international global peers, but probably getting their growth from a wider base and some of it from emerging markets. So yes, something that's related to the pickup in growth, some resource exposure and maybe some fixed income exposure here and there.
Well, it's fixed income in South Africa, because you mentioned there had been a bit of a sell-off in local bonds over the past month or so. So does that create an opportunity then for investors? Indeed,
I don't think the fundamentals have changed so much over the last 2 weeks that justifies bond rates to be 50, 60 points higher. So that's classic, a shorter term opportunity that does arise. You know, everybody's been sitting on the side, sitting on a lot of cash, and it's been difficult to find good investment opportunities for that. So if the market changes in such a short space of time, and yes, it does deliver a good opportunity, suddenly now looking at our market and the long end paying 5% real, suddenly that starts looking like the correct number, yes.